If you aren't tracking insider trades, you are missing out on massive earnings alpha. Just a couple of weeks ago, we found a director at CorMedix making his largest purchase ever out of 14 previous purchases, and it was over 3 times larger than any of his previous purchases. On top of that, he averaged 25% 6-month returns after his previous purchases, and earnings were just 2 weeks later. Well, that 2 weeks later has just arrived, and earnings were this morning, and the stock is up 8% after announcing good earnings. Just think about it. What is the main thing you are trying to avoid on earnings calls? It's those massive 10, 20, 30% drawdowns that can happen in just a single day. Obviously, if an insider is buying the stock just a few weeks before earnings, they already know how the quarter has gone because the quarter has typically ended anywhere from 2 to 6 weeks previously. And it's very unlikely that they would be buying the stock before a massive earnings dip and before wildly missing earnings. On the flip side, you also get a chance that earnings come in good and the market loves it, and you get the 10, 20, 30% upside on the other side. But mostly, insider buying around earnings is mostly about risk mitigation because they're unlikely to buy before terrible earnings. So then we can skew the earnings in our favor and have more confidence that the stock is probably not going to tank during earnings, and we might even get some upside, which obviously gives us plenty of ways to play that trade. Head over to CEOWatcher.com for all the top insider trades.